Okay. There, now that we are set to go, I wanted to just take a moment to introduce myself. As Amy said, I'm Cindy Shoemaker. I own CMU Shoemaker Consulting. I have been in the charter school movement for almost 30 years. I hate to say that, but my son was 4, and he is turning 30 years old today. So, not today, I'm sorry, this month. So I've been around a long time. I spent 20 years with the Central Michigan University Center for Charter Schools. They were the first university authorizer in the country, and there weren't that many charter school authorizers at the time. So I was brought on to really help develop systems and processes. Because prior to my role at the center, I was a certified public accountant and also an internal auditor. So it really would fit in my wheelhouse to really help them establish their systems and processes. I also wanted to just share a couple of the partners that I've worked with, just so you can get an understanding of a little bit about my background. But through my consulting, which has been the last 6 years, I have worked with the National Association of Charter School Authorizers, or we call them NACSA. NACSA is our standard setting organization for authorizers around the country. I've done several projects with them, but the most current project that I did that is most applicable today is they offer a financial framework as a best practice. And I worked with them to actually update the financial framework. So they have 3 frameworks: the academic, financial, and operational. And I was tapped to actually facilitate conversations. And we'll talk a little bit more about their framework in a few slides. I also work with an organization called National Charter School Institute. Some of you may be familiar with them. They are an organization that works with authorizers, schools, boards across the country. I spend, while I do board mentoring and things like that, I spend a majority of my time on projects working on fiscal oversight with authorizers. I help create fiscal scorecards through a platform called Epicenter. Some of the other partners that you see there: Chicago Public Schools, Central Michigan, Utah. I've been working with them to develop a fiscal oversight system that's on a risk-based model. And then there's a couple of clients that aren't up there that I actually do their fiscal oversight for them as an authorizer. And so just wanted to share that with you so that you had a little bit of a sense of who's talking at you today. So I'm happy to be here and look forward to the conversation. I wanted to start out with the mission because I've had the pleasure to work alongside the team with the Mississippi Charter School Authorizer Board for a couple years now. Dr. Kay and I met through our association with the National Association of Charter School Authorizers. And since then, we've shared a lot of thoughts, been good thought partners for each other. But one thing that, I just felt was really important for me to share, that their mission talks about high quality. And, they're not only required to authorize charter schools, but they are required to ensure that the schools that they authorize are of the highest quality. And like many authorizers around the country, they're not interested in authorizing just to authorize. And that comes from my firsthand experience of working with them. But they truly are focused on ensuring that we have high quality schools. So the objectives for today, we're going to talk about the why, the what, and the how, all focused around the financial performance framework. So it's my understanding that you had a session previously where you talked about the academic side of the house. We're going to talk about the financial side of the house today. We're going to spend a little bit of time on the why and the how, and most of the time on the what. So the goal for today is just to share the framework. I'm under an assumption that many of you have seen it, but we'll dive into each of the indicators individually. Again, we are a small group. Please feel free to ask any questions. I've been doing this work for a lot of years, so if I use a term or an acronym that you're just not familiar with, feel comfortable to raise a hand, put it in the chat. Amy's going to help me with that. But there are no dumb questions today. So we're going to start out with the why. Why is there a financial framework? Well, the board is required by statute to incorporate performance provisions in the charter contract based upon a performance framework that will guide them. And I have 3 different screens going, so I apologize if I'm not looking directly at you at some point, but this is to guide them in their evaluation of their charter schools. Now, the law requires several things as a minimum be included in the performance framework. H is what we're going to talk about today, that they are required to include financial performance and sustainability in their evaluation system. But the board is also required by law to carry out all of its duties in a manner that is consistent with nationally recognized principles and standards. And I mentioned NACSA earlier. The National Association of Charter School Authorizers really is that organization that sets the standards for authorizers across the country. They provide guidance on contents of performance frameworks for the academic, operational, and financial. And as I mentioned earlier, I was the lead facilitator on helping them update these last year. What I wanted to share was that the biggest change that came out of that work, and then we gathered authorizers around the country to have conversations to find out what's working, what's not working. We're down the road I think it had been 10 years since they had updated them. We've learned a lot. What do we need to change? And while they changed a couple of the indicators, probably the biggest single, most impactful change is the fact that they used to provide what I'll call a cookie cutter performance framework and say, here's the financial framework. This is what all authorizers should use. They no longer do that. They recognize that environments are different from state to state, and that it's important that an authorizer consider their environment when they are creating their financial framework. And I think from my understanding and what you'll see today, that the Mississippi board and the team, the team that worked on this, they hired a well-respected consultant to lead in the development of their frameworks. But I think what you'll see as we go through it, and I'll try to point out a few of the things, there definitely was room for local context. And my understanding is that through the process that was put in place to come up with the framework, there was opportunity for local input. So I think, that's really important, and NACS is recognizing that now. And what they did was when they updated the financial framework, they actually, I don't remember how many indicators they had, but it was less than 11. They originally had 4.
2 were financial.
Okay.
That was it. Debt to asset ratio.
That was for the board, the Mississippi board. Okay. And so with NACSA, I think they may have had 8 originally. They now have 11 that they recommend. But what they said with those 11, and with this idea that you need to make sure that your framework meets your environment, is they don't expect every authorizer to use all 11. But instead of what they feel are the best practice indicators, and recommend to the authorizers that they consider which one of those makes sense for their environment. But they do the other thing that I wanted to say is that I also did some research, and I say that loosely. I went out and I gathered, actually with my work with the National Charter Schools Institute, I gathered performance frameworks, financial performance framework from authorizers around the country, and just did a little test to see if an authorizer is using the framework for accountability, because some of them don't use it for accountability, they use it more for transparency. But if they're using it for accountability, on average, you'll see 8 indicators that authorizers are using. Mississippi has 9, and we will get into each of those here in a minute. But NACSA The other thing that they recommend is, while they have the 11 and they say, pick what makes sense for your environment, they do recommend that you have some that are short-term, and they recommend long-term. And then there's a category called fiscal management. So they said, whatever you pick, just make sure you're focused on some short-term, some long-term, and some just good management practices. Based on working with Mississippi and reviewing the financial framework and my work with NACSA and other authorizers across the country, I think that the framework that Mississippi has aligns very closely to NACSA with their recommendations that they consider the environment. So that's really the why, and why there is this framework. Now I want to move into the what, okay? And this is where we're going to spend most of the time today. As I mentioned, Mississippi has 9 indicators. They have 4 short-term, 3 long-term, and 2 financial. Now, the short-term indicators are indicators that really look at the fiscal health of the organization through the lens of the current year. Okay, so short-term is truly that, short-term. It means the 12 months. Okay, they focus on liquidity. So what assets do we have that we can convert into cash quickly? And so they're really trying to answer the question of, does an organization have enough liquid assets to operate for the current year? And when we get into the current ratio, we'll talk about what some of those liquid assets might be and where you find them. But that's what the short term is focused on. The long-term indicators are indicators that are looking at the fiscal health of the organization over time. So what do we see trending and over time for the organization? They're really focused on sustainability. Is the organization going to be sustainable over time? And so it's really trying to answer the question, does the school have enough assets versus their debt to operate into the future? Have they set the school up for success over time? And then the third group is the financial management and oversight. Now, these are indicators that look at the fiscal health of an organization from a management perspective. So the question that they tend to answer is, does the school have the systems and processes in place to ensure a viable organization? So just as the Mississippi Board has a framework, that's part of their system and process to evaluate schools. What we're doing with the financial framework is looking at whether a school has established certain processes and procedures to ensure that it's a viable organization. So I want to pause right there before we dive into the details, because that's where we're going to head next. Let's see if there's any questions on the short-term, long-term, or financial management and oversight and the difference between those. I don't see any, so I'm going to go ahead and move forward then. So before we dive into what the current ratio is, which is the first short term, what you're going to see in the presentation going forward is this white box, if you will. This is directly from the framework. This is an excerpt of the framework, did a screenshot with the idea. I wanted to just spend a moment talking about what we're looking at here, because it's consistent for every indicator. Okay, so this is the current ratio, but so you'll have the measure, or the indicator is a short term. So the indicator level is short term, long term, or financial management. You have the measure. In this case, it's the current ratio. But then you have this box here that again tells you what the measure is. The measure type, it's either performance or compliance, and then the metric. So it's really, what is that metric of how this is going to be evaluated? And it's the, and I'm going to come back to the current ratio, and so we'll go over it specifically. But then there's something called the target differentiation. Now, Mississippi understands that schools in their infancy, has a lot of startup expenses, a lot of things that they have to consider. So some of the measures, you'll see that there's actually differentiation of the target for those schools in their first year and second year versus schools that are 3 years and older. Okay, and again, it's just that recognition from Mississippi that they're, those first 2 years are challenging, and it's given them a runway to get to the targets. And then over on this side of it, where you see the color, are really the targets, and you can have the fails to meet, approaches, or meets expectations. Okay, just due to the limited time today, we're going to focus on the meet expectations. Okay, again, you can follow along if you have a copy of the framework, with you, because this is exactly from the framework. The other thing that you see for each measure is you'll see the data source, exactly where the numbers are coming from. And then you will also see the metric calculation, the actual formula. Again, I'm not going to spend a lot of time on the formulas today because we just don't have the time, but it's in the framework and you can go back and check on that. The other thing that the framework includes is a cut score notes. This is really providing context around that expectation, the target. So it just helps everybody understand that these numbers weren't just pulled out of the air. And I can say that, based on my work across the country and also with NACSA, the meet expectations that we see are pretty standard in the Mississippi framework. So they've done their homework and know what the industry is out there. Okay, so let's talk about the specific indicators now. We're going to start out with that current ratio. Current ratio, short term. So just pointing it out, and I apologize because I'm using my pointer and you can't see where I'm actually at. But the short term, it's a short term financial health. So remember, I said that focuses on liquidity. Okay, so it's asking the question, does the school have enough resources to meet short-term financial obligations or those due within 1 year? I want to unpack that statement. It says that you have to have enough resources. Again, we're thinking short-term, we're thinking liquidity, liquid assets. So we're thinking about things like cash, accounts receivable, or maybe even prepaid expenses. But they're things that can easily be converted to cash. You might have some investment accounts, but things that can be converted to cash very easy. And then you take those to meet the short term, so the current year financial obligations, which are your liabilities, the things that you owe. So it would be like your accounts payable, maybe some accrued payroll, maybe the current portion of some debt payments. If you have a loan that's out there and you have the 12 months for the year. So it's really taking the current assets and the current liabilities. And if we go back to the table and look at the metric, it is the ratio of the current assets and the current liabilities. So, and when we go over to the target over here on meet expectations, what we're saying is that you really want to have assets to liabilities of 1.1. So you have a little bit more assets than you have of current assets. I'm sorry, you need to make sure that we stay in that current bucket of your current assets are greater than your current liabilities. Just like at home, you'd like to know that you've got more assets than debt that you created, okay? And then with this one, it's actually an or statement. And this is kudos to Mississippi from the perspective of they're recognizing a school that's headed in the right direction, if you will. And so the target is greater than or equal to 1.1, or if you're between 1.0 and 1.1 and the current year trend is positive, or the 1 year trend is positive, you'll also meet the expectation. So there's that recognition of, you're headed in the right direction. You're not quite at that 1.1, but you're pretty darn close and heading that way. As far as the data source for these, this will come from the statement of financial position, otherwise known as the balance sheet. When you get into governmental, nonprofit, there's a lot of different words, but a lot of people recognize the term the balance sheet. And so they'll use the audit in order to calculate this one. And then there's the metric that we talked about in the cut score context. I'm going to stop right here and see if there's any questions about the current ratio. Okay, we're going to move on to the next one. The next one is measure 1B, the unrestricted days cash. Again, it's short term. It is, therefore, it's fixed or still focused on liquidity. And it's answering the question, does the school have enough cash to pay its operating expenses? Okay, so if we unpack this one, it's really talking about, do you have enough unrestricted cash? And that's cash that's available for operations. And I'm going to come back to that in just a moment. To pay its operating expenses. What does it cost to run the school for the current year? Okay, and I want to go back to that unrestricted cash. So cash is cash, but some schools, it doesn't happen all the time, but occasionally we'll have some kind of a legal restriction. Generally, it's associated maybe with some borrowing that says that they need to set some money aside, okay? But there's a legal restriction to do that. And so if a school is required to do that, then in the audit, you will see what they call restricted cash. It's still cash, it's still an asset, but the school has to save it in order to meet a covenant that they've agreed to. But that means it's not readily available for operations, right? So in this measure, we can't consider the restricted cash. We would only consider the unrestricted because that is what is available for operations. Again, it doesn't happen all the time, but I thought it was worth at least bringing that up for those schools that have. If we look at the actual framework, the metric is ratio of unrestricted cash and total expenses. This is where you see a differentiation again for year 1 and 2, and which is that the days cash on unrestricted days cash should be equal to or greater than 30 days cash. But if you're year 3 or greater school, then the expectation is that you would have 60 days. But again, they've got the or to give kudos to a school that is moving in the right direction. If they're between the 30 and 60 days and have a 1-year trend that's positive, then you would meet the expectation as well. I couldn't fit it all on one page. So as far as the data source for this, you're going to find your cash on your balance sheet or your statement of financial position. And then your operating expenses are on your statement of activities, which is like your income statement. Any questions on unrestricted days cash? Again, it's just really trying to ensure that the school has enough cash to pay its operating expenses.
Is there any consideration for like major shifts to rent expense related to the new accounting standard ASC 842 for long-term leases?
Well, how would that?
Because so if you have and maybe this isn't necessarily the school I work with in Mississippi, but I have some other schools that they had some significant long-term leases and they are operating leases. So when you make your ASC 842 entry, the operating rent expense, though it's non-cash, in some cases has gone up pretty significantly and turned like some $1 million surpluses into like $1 million deficits. So it's technically hitting your rent expense, which is operational, but it's non-cash. So would there be some kind of consideration to kind of back out that non-cash expense similar to depreciation?
From a depreciation expense, it is, I mean, the calculation does consider depreciation. That's a question that maybe we'll have to get back to because Lisa and I haven't had that conversation as far as what impact that, that new standard has on it. But good question, Kyle.
Thank you.
Okay, so the next indicator measure is still in the short term. It's called the current year enrollment variance. Now, of course, you know, this isn't a liquidity per se, but you can get it there because your enrollment is your single largest revenue. Your revenue drives your cash. But we're also focused on that current year. So this is why it's in the short term. But this measure evaluates how well a school is meeting its board approved enrollment that is in the budget, okay, that the budget is based upon. So the question is, will the school meet the revenue targets as established in the budget, which is your largest revenue item, and therefore be able to fund operations? This one, it's a simple metric of the ratio of the actual enrollment compared to what was in the budget. If the actual I guess I should stick with this, and there is no target differentiation, and the meeting expectations is that the actual enrollment is equal to or greater than 95%. Okay, now if a board doesn't meet this expectation, there's a couple things that our school doesn't meet this expectation. A couple things that I think of is that it's either we need to take a look at our budgeting process, that maybe we weren't realistic in our enrollment projections, or two, there truly is an enrollment decline within the within the school and the area, and then that becomes a long-term conversation, or a long-term indicator, I guess, that as the board we need to take a look at that and say, what are we going to do to ensure that our enrollment our enrollment projections are met? So could be a couple of different things that are going on there if you don't meet it, but it's definitely something to take a look at. The enrollment variance, the data source is the July 31st board approved budget, and then the actual enrollment as of October 1st, based on the submission. Any questions on enrollment? It's fairly straightforward.
I just put in the chat a question about it, just to clarify, it's not related to contracted enrollment at all, right? It's the board approved.
Correct. Or Lisa, you can help me if that's wrong, but my understanding is the board approved in the budget.
Yeah, and ideally
versus the actual, not what your contract says that you're contracted for. Is that correct? Oh, Lisa, you're on mute.
Sorry. No, we have used the contracted number because that is what the school is contracted for, and that's what we're expecting, I guess. Amy can correct me if I'm wrong, but we have always used the contracted number for this number.
I just went through this for Republic, and I was looking at it's the actual definition of it is the board approved number.
Mm-hmm.
I realized the way you guys have calculated it in previous years was based on the contract number, but the actual language, as I understood it, was the board approved number in July versus the October number, the actual number in October.
Yeah, and I apologize, Lisa, if I've created confusion, but that is what the framework says, is that it's the July board approved enrollment budget number. So if there's a discrepancy there, we probably need to think about that. And
yeah, we definitely do, because I think, and I hate to assume, I know what that does, but I guess when we began this work and worked on these, we assumed that the schools were using their contracted budgets or those numbers for the enrollment, because those are the projected numbers we use for funding for MAP, well, MSFF now. So if we need to go back and circle back and make an adjustment here or there, or determine something different, then we certainly can. But and Angela, I know we have talked about that difference where you guys had budgeted something different in terms of your
Yeah.
enrollment. Yeah.
I thi-
So yeah, and good question. And we definitely need to follow up on this.
Yeah, because in the contract it gives like it talks about like not going above like
120%.
Yeah. So like kind of there's some like room for fluctuation. Of course, like if it was like wildly different, then we would do the contract amendment. But sometimes it's not. I don't know if it would cause like an issue with the performance framework because it's like close together, but I was just wanting to get some clarification there.
So a good question, and I saw your question in the chat. So thank you for bringing that up, and we'll follow up on it for sure.
Thanks.
Thank you. So then the next measure is the, excuse me, debt or lease default. This is the last indicator in the short-term arena. So again, we're thinking current year, and it helps determine if a school is paying its debt in a timely manner and is in compliance with its loan covenants. Default typically occurs when a school doesn't make its minimum payments. As it shows, it does include leases as to be considered part of debt. You know, the metric is compliance with the loan covenants and debt service payments. So meeting expectations means that the school is not in default of a loan default or loan covenant, or is not delinquent with debt service payments. And when the board or the team is looking at this, they're looking at the notes to the audited financial statements to discern if there's any concern with this or not. Any questions on debt or lease default? All right, now we're moving into the long term. And just as a reminder, these are indicators that look at the fiscal health of an organization over time. They focus on sustainability. So they're really trying to answer the question of, does the school have enough assets versus the debt to operate into the future? So short term was that 12-month period. Long term is for the future. It's asking, does the school maintain a healthy balance between assets and liabilities? So as we unpack this, since we're talking long-term, we're talking about total assets and total liabilities, not just the current portion like we were talking in the current ratio. So as we look at the table here, the metric is your ratio of total liabilities and total assets. There's no differentiation for the target. And then the meet expectation is less than 0.9. So basically what it is saying is that you want to have 10% more assets than you have liabilities. And I think, you know, that makes sense. So you always want to be more to the positive than into the negative. Data source for this one is the statement of financial position or the balance sheet as well. Any questions on the debt to asset ratio? Okay, moving on to the next one, which is a total margin. Again, this is long-term over time, and it is really looking at, is the school managing cost appropriately within its available resources for the current year, as well as over the 3-year time period. So the current year is important, but we're really looking, because it's a sustainability measure, we're looking over a period of time. So basically it's saying, does a school have more revenue than expenses? Are they living within their means and not spending more than the revenue that they collect? And as we look at the table here, the metric is the ratio of net income to total revenues. This one does have a differentiation for the year 1 and year 2 schools versus the year 3. Obviously for year 1 and year 2, you don't have the 3 years worth of data. So when you're looking at the metric for that one, it is the current year total margin is positive or greater than 0. If you are 3-year schools, it gets just a little bit more complicated because it's looking at 3 years, if you will. It's the 3-year total margin is positive. So that's year 3 minus year 1 is positive or greater than 0. And the current year total margin is positive. So that's one way that you can meet the metric. But if you're not quite there, you can meet it by your 3-year total margin is greater than a negative 1.5%. So what this is saying is that they're allowing for the idea that there is a year where a school may spend more revenues than they took in. And, you know, sometimes that happens strategically, or most of the time, hopefully it happens strategically, where they've been saving money for a particular project or certain expenses, and then the expenses come due. And so that year, excuse me, they show a negative. So what they're looking for here is that that's okay as long as it doesn't put you really far into the negative, and you have a positive trend in the last 2 years, but that current year is positive as well. The data source for this would be the statement of financial. No, this one we found that this one is a typo, and it's really the statement of activities, because you're talking about your income statement. And then for the 3 years, they'd have to have 3 years worth of data. Whoops, sorry about that. I went too far. 3 years worth of data. So again, this one is just, you know, are you living within your means of for that year, and then going back for the 3 years and looking at it kind of over the 3 years, what does that look like? Any questions on the total margin? Okay, hearing none, we'll move on to the third measure in the long-term category is cash flow. And this really answers whether a school is managing its cash to support the school's operational activities over time. As we look at the table for this one, excuse me, I need to take a drink. We are looking at the trend in the cash balance from year to year. Again, there's a differentiation between new schools and schools that have been operating, with the idea that new schools, if they have 1 year cash flow or the total cash balance is positive, they meet the target. Whereas a 3-year, they're looking at the cumulative cash flow is positive, and that's the 3rd year minus the 1st year, and the cash flow is positive each year. Or again, there's a second way that you can meet this expectation, and that is your multi-year cumulative cash flow is positive. The cash flow is positive in 1 of 2 years, and the cash flow in the most recent year is positive. As far as gathering this information, you know, they're going to look at the statement of cash flows, or they can look at the balance sheet or the statement of financial position where the cash balances are there. But it's a matter of looking over the 3 years. Again, that, you know, any questions on the cash flow, but it's really just about cash management and, you know, how is the school doing from a cash flow perspective. Okay, financial management and oversight. So this is the third category, and the final category or indicator, I guess is what I should say, for the framework. And as a reminder, these are indicators that look at the financial health of the organization from a management perspective. So does the school have the systems and processes in place to ensure a viable organization? And this first indicator is the board and MD financial reporting and compliance requirements. So is the school complying with those reporting requirements? It's a compliance measure. There's really not a formula. And it's one of those things that either you did it or you didn't. So we don't have a middle of the road. And they're really looking to see that the school fulfilled all legal and contractual obligations related to financial reporting and compliance. And when you look at the data source, you can see that there's several data sources that they're looking at for this. But one of the big ones would be anything that the board and the team are asking the school to submit through their calendar requirements. And I know you guys, they use Epicenter so that, as far as getting the information, they're able to collect that through Epicenter, but also looking at notices from the Department of Education, and then some other data sources as well. Any questions on this financial management measure? Because really, this is one compliance versus everything so far has been a performance indicator, and but this one is in compliance. Okay, the next indicator, I'm sorry, the next measure is the annual financial audit and generally accepted principles or GAAP requirements. And so this one is the school complying with financial practices and management expectations. And if we look at the table, it's another compliance. I could make the case that it might be about performance too, but it's really looking at, did the school fulfill all legal and contractual obligations related to financial management and oversight? And I seem to have lost my mouse capabilities again. Let me see if there we go. I'm just going to try to use the keyboard and see if that'll work. What they're looking for here, and this is from the audited financial statements, that the audit was issued with an unqualified opinion, meaning that the financial statements were presented fairly, and that the audit didn't have any significant findings, recurring findings, material weaknesses, or significant internal control weaknesses, and that the auditor doesn't have any concern with the ongoing operations of the school. And again, the source on that is the audit. Any questions on this last measure regarding the audit? It's a pretty standard indicator that we see across the country. Okay, so now we've touched on truly what's in the framework. Next, I wanted to talk about the how. I'm not going to spend a lot of time on this, but I just thought it's really important for everybody on the call to really understand that you have an opportunity to impact this if need be, okay? The team wants to get it right. This is an evaluation tool. They want to make sure it's 100% accurate. So they collect the data through the different sources that we talked about for each of the measures. They enter the data into the financial framework workbook, and it's an Excel workbook that brings everything together. Oh, I should have mentioned, when they collect the data, as they're collecting it, if they see something that just seems out of whack, just something that just doesn't seem right, they may reach out to the school right then and there and ask them for clarification on it. But then they enter it into this financial framework workbook, and then they ask the school to verify the data. So this is an opportunity for you to take some time and say, do we agree with the data that has been or that's being used? Once the data has been verified with the school, they actually start the scoring, and the scoring occurs between each measure. So if you remember, there's the short term, the long term, and the financial. I'm sorry. There's within the short term, there's four of them. I don't have the numbers right now, but there's 9 of them in total. Each one of those measures gets a score. Then they average the score for those measures by the indicator. So if they're in the short term, they're averaged together and get a score there. If they're in the long term, they're averaged together and get a score there. If they're in that financial management, they're averaged together and put there. And I'm going to show you an excerpt from the workbook so that you can see kind of what this looks like. But then once they get those indicator scores, Then they bring those 3 scores together and average them to produce an overall score. Then they submit the report to the school for review. So this is the other area that you have an opportunity to impact it. You are given 15 days, business days, to submit evidence of any factual errors. So obviously, the team has been using a source such as the audit. If a school were to say that's not accurate, they need some kind of evidence to help them support that change. I think that's pretty reasonable. But you have that opportunity. So take that 15 days and take a look at it, because as I said, they want to make sure that this is accurate. They're not interested in issuing a report that's not accurate. You can submit the evidence. They'll take a look at it. If they find that there's a factual challenge, they will update the data accordingly, and then they will issue that finalized report. What I wanted to show you with the finalized report, this isn't the final report, but it's a subsection of the report. And if you look at the top of it, it says short-term financial health. So that's that indicator, right? The short term. And within that are the current ratios and the unrestricted days cash. I'm sorry, my pointer is not working. What you see is the rating. So you have the meet expectations, approaches expectation, the fails to. Then you see a score next to it. And you probably have noticed this throughout the framework because it's listed. But if you're meeting expectations, you get a score of 3. If you're approaching, you get a score of 2. And if you fails, you get a score of 1. Then it goes on to explain the criteria for this particular measure, which is the current ratio. And if you look down below that, you see the current ratio. It tells you the measure type. It tells you if there's a target differentiation. So it actually tells, so this is a particular school's report. So there wasn't a target differentiation for the current, for this measure. But you'll see in the next example, if you're a 1 or 2 or 3, it tells you. But then it says the total ratio of 3.3. That's the actual result for this school. So they have a current ratio of 3.3. And if you compare that to the criteria, it's greater than the 1.1. So they met expectations. So they got a score of 3. Okay. If you follow below that, the next one is the unrestricted days cash. Same thing. You see the expectation or the ratings, the score, the criteria. If you look just below that, it tells again that it's the unrestricted days cash, the target differentiation. This is a school that is 3 years or greater. So that tells me I have to, when I look at the target, I need to look at the target for a school that's been in operation for 3 years or more. And that the requirement is that they would have 60 days cash or 30 to 60 days cash, and 1 year trend is positive. In this case, the school has 98. So this is the actual result for the school for the unrestricted days cash. Therefore, they're meeting expectations and get a score of 3. So they continue on for each of the measures and go through this process. Then, like I said, for the short term, they bring it all up, they average it. For the long term, they bring it up and average it. For the financial management, they bring it up and average it. Then they bring it up and bring it all up and actually have, like at the top of it where it says financial performance and meets expectations. This is a school that has, on the financial framework, met expectations. So if you didn't meet some of the expectations to where that averaging caused you to be approaching expectations, that green meet expectations would be orange and say approaching expectations. But this is just a piece of the report. I just wanted to share a little bit with you just to make sure that there was an understanding of that. I think this is the financial side of it. The board actually, has the 3 frameworks. They are all standalone frameworks. So it's not like they take the finance, the academic, and the operational, put them together to come up with 1 score. They don't do that. They keep them, they're 3 individual tools to help them in their assessment of the school. So going back to that very first slide, this is the tool that helps guide them and helps in their evaluation of a school. Now, it's only a tool. It's not a if this, then that. It's a tool where they are able to do the assessment. But one thing that I've learned about authorizing is there's an art and a science to it. And we all know that numbers on a paper are numbers on a paper based upon good information, but things change, right? And things are different. And so that's where we talk about professional judgment and authorizing. And it's something that's really important. And it's something that NACSA has even recognized. They didn't like that at first. They thought it should be a cut and dry rubric. But over the years, they've realized, like I said, this is an art and science. And there's times where, schools may not, there's just additional information that an authorizer needs to be thinking about as they're making a final performance rating for a school. And so I just wanted to share that experience with you. Any questions on the how? Looks like we've got some questions in the chat.
Yes, I've just been answering those.
Okay. And then I will. So I've done a lot of talking. I have a question for you. So this is the tool that the board uses, the team and the board uses to do their evaluation that's required by law. But my question to you is, how might a board use the indicators in the framework to help them govern effectively? I'm going to give you just a minute to think about that. And if anybody wants to share some thoughts on that, I would gladly open the conversation. Do you think this is just a tool that the Mississippi Charter School Board should be using, or could it be helpful to a board at the local level?
I'm not a board member, but I will definitely say that these kinds of ratios should be examined on a monthly basis or at every board meeting. I'm not talking long-term ones necessarily, but certainly the current short-term ratios are important so that decisions can be made to make sure that you're financially responsibly governing the charter schools you're obligated to manage.
Thank you, Joe. That was honestly the answer I was looking for. I was hoping to get, because you can think about this as something that's being done to you, or you can think about this as something that they're providing this information is to be helpful. And these are standard financial indicators. There isn't anything here that, you wouldn't see in a lot of other frameworks across the nation. I would encourage boards to really work with your business managers, because there are nuances in the numbers, and the business managers know those numbers better than anybody. And if you're if you're on a cash basis versus accrual basis, that can affect how some of these might end up. But the business manager should understand those nuances and be able to help the board think through that. And the reason that's really important is because as a board, there's two things. One, nobody likes surprises, right? So do you want to wait until the Mississippi board issues their report and then you see you're not meeting some of the expectations? Or would you rather know up front that maybe you won't, and I can make some adjustments so that we will? Or, you wait and see. The other one is that idea of being able to make some adjustments. If these indicators can help you as a board to say, hey, we don't have enough cash on hand, or, it can bring up a conversation. And that's what I really like about frameworks, is you can use them for conversational, to get conversations started. I have a client, just as Joe suggested, that I do their oversight for them. They have indicators for the monthly financial statements, and then they have indicators for the quarterly financial statements. And I have to run the indicators for their schools accordingly. Then we meet with the treasurer every month, and I share with them my assessment on those indicators. Well, they've taken it to be very proactive in that they created a board report that actually reports out on these indicators. So the board knows exactly where they're setting on the indicators and what's going to be discussed at the meeting with their authorizer. And so therefore, if they feel like they're not going to meet some expectations, either they know why and they're good with that, or they want to make some changes and be able to move forward to meet the expectations. Because again, it's not just the expectations of the board. These are standard industry things that we're seeing, that we're using for targets. So, but there are reasons at times that a school might not meet something. So with that, as we're closing in on an hour, I just wanted to make sure that you're aware that, the framework is available on the website. There's also a guide, internal companion guidance is what it's called, that's out there that helps explain a little bit more. So if you're not familiar with that, pick that up. My understanding is that you have another training coming up November 15th for the operational performance framework. And then if you have any questions, if they're finance related, please reach out to Dr. K. If they're legal related, please reach out to Amy. And with that, I want to close in by we do have a couple minutes to see if there's anything that I didn't cover that you were hoping or you're wondering about, or maybe there's something that you want clarity on. We can take just a few minutes and see if I can answer any questions.
Hey, Cindy, there is another question in the chat that I need a little clarity on because, I'm an attorney, not a CPA, so I'm not 100% on what a working model is. So if Joe could clarify that and maybe you could answer, that would be great.
Sure. So the workbook that you guys use to put the information in, the numbers, is that something that are you distributing that so that we can actually see the calculations, or is it being distributed in like a PDF format?
Lisa, I'm going to let you and your team take that answer or that question.
Joe, you guys, the schools actually get a copy, excuse me, a copy of the workbooks when they get an opportunity to review the data, like Cindy was saying during the process. So you can look at the formulas that are built into the workbook, and you can look at the numbers that are in the workbook relative to the financials. And then if there is any error or anything that needs to be updated from that point, then we can adjust that before we do the finals.
Okay, so it basically includes all the formulas and everything. So that's what
Yes, absolutely.
Yeah, no, that's this has been a very good session. I appreciate all the work that went into this. So thank you so much.
Thank you. I appreciate that.
I think we have time for one more. Amy, I apologize. My mouse is not working, so I can't get into the chat to see what that is, but I see the number has increased to 6. So is there another question that I could answer? Or?
That was Gloria Chapman Brooks asking if we would, if they would be able to come back and review this Zoom call. And yes, we are recording it and it will be posted to our website soon after, I guess just as soon as we get it ready to be posted, it'll be up on the website. And we can send that out if you would like us to send that to you, just let us know.